he can, as per this last clause, he can issue notice, and it will be taxed in the year in which he issues notice. So some of the issues which we have highlighted over here is whether bogus expenses can be declared as undisclosed income, because it says the income which has escaped, which is chargeable to tax. So this I think can be covered, will get covered. The second is whether tax on fair market value as on 1/6/2016 is reasonable or would disincentivize. As we recently noticed, even in case of under Black Money Act, this was one of the disincentive for making the declaration, because the properties which were acquired outside India, the fair market value was very high. Say for example, you may have acquired at 10 lakh rupees. Today the value may be 50 lakh of rupees. So your tax liability, 45% of that 50 lakhs would be in fact more than the amount which you originally invested.
No, this is cost of purchasing fees. That's your call.
So that's this.
How many people will really avail of this?
No, it's entirely up to the
because
individual.
as we know that Black Money Act, there were not many takers for it.
Right.
So maybe because of these kind of provisions, or this was also one of the provisions there,
Right.
that we take a fair market value,
Right.
and it was a deterrent. Maybe it will act as a deterrent here also.
Right.
Now the another question comes is what happens if investment is made fully or partly out of borrowed
No, but I
funds?
think the other question will be what we are debating is, can then a notice under this scheme be issued at any point of time without having regard to the bar of limitation?
It appears so.
No,
I think someone
I
will
have-
have to challenge
I
it.
have my grave doubts whether this is a parallel
That would be
legislation.
This is a parallel legislation,
Parallel
parallel to the Income Tax
legislation.
Act.
To the Income Tax Act,
Yes.
and having an unlimited, indefinite limitation under the statute.
Absolutely. So it's like equalization levy, that is also not part of the Income Tax Act, and outside of it.
No, but this is intended to bring errant taxpayers to the book by asking them to make a declaration.
Yes.
But you are using this in the reverse to say that if you not made a declaration,
So
Correct.
that's a stick. That's a stick being applied in the
No, but you cannot do away with all these
Yes.
provisions
Right,
which
I
have been
think
there
so,
for
yeah.
so long.
Yeah.
Yeah, correct.
And the bars of limitation, you
Right.
cannot just indirectly
Right,
seek to revoke all those bars.
Right.
So I was on the third bullet where the investment. I will give an
so
example.
you have actually two streams of income.
Yes.
You may have under the scheme that undisclosed income can be brought to tax here. Regular income you bring to tax under the Income Tax Act, and then there will be debate of whether what is undisclosed income, bogus expenses, whether it should be going under the normal Income Tax Act or it should be assessed here
Correct.
as under the scheme as undisclosed income. I don't think you can have a parallel legislation of this kind.
Correct. So I was on the third bullet where the investment is made partly out of borrowed funds. I'll just give an example. So supposingly you originally purchased an asset of 10 lakh rupees and you borrowed 6 lakhs rupees to purchase that asset. So normally under the Income Tax Act what can be taxed is only 4 lakhs of rupees, so long as you are able to substantiate the source of that 6 lakhs of borrowed funds. Now under the new act, under the scheme, what it requires is it taxes you on the fair market value. So supposingly that asset which you originally acquired was of 10 lakhs, the present value is say 50 lakhs of rupees. Whether you will at all get a deduction, if yes, whether you will get a deduction of only 6 lakhs of rupees which you borrowed, or you will get a proportionate deduction with reference to the fair market value. If you analyze the undisclosed Black Money Act, it specifically provided, in fact there was a clarification issued but subsequently by the board also, which say that in case of borrowed funds, you will get a proportionate deduction. So in the earlier example, if 6 lakhs of borrowed fund were utilized to purchase an asset of 10 lakhs of rupees and the present value is 50 lakhs of rupees, so under the Black Money Act you get a deduction of 30 lakhs of rupees. There is no such corresponding provision under the present scheme. I think that requires a clarification from the board to that extent. The last bullet I have already dealt that there is no specific provision for treatment of the fair market value as the cost of the asset which is declared. This I think we have debated whether undisclosed income of assessment year barred by limitation of 6 years is covered by the scheme. So on a hyper-technical reading of the provision, it says that you have to make a declaration, and if you don't declare, it can be brought to tax subsequently by issuance of a notice, which again is a very going to be a highly litigative issue as to whether or not the assessing officer does have the authority to issue your notice for an year which is already barred by limitation. So this was in so far as the this scheme was concerned. Now coming to the next scheme, which is the Direct Tax Dispute Resolution Scheme 2016, which is something similar to the Kar Vivad Samadhan scheme, which was introduced way back in one of the earlier budgets. It specifically covers two kinds of cases. It covers two kinds of cases. One is where the demands where the appeals are pending before the CIT appeals, which are normal appeals, and secondly where the demands are arising on account of retrospective amendment in law, which one can refer to the Vodafone controversy. So first is they have categorized as the tax areas where the appeal is pending before the CIT appeal, and second they categorize as specified tax. In case where the appeal is pending before the CIT appeal, one can go and file an application declaration under this scheme, and by making payment of tax, interest and 25% of the penalty, one can resolve this pending dispute which is pending before the CIT appeal, and the matter will get closed. In so far as pending penalty appeals before the CIT appeal is concerned, again you have to pay tax, interest and 25% of penalty, which is the normal penalty which is payable. And this penalty is payable only in case where the tax is more than 10 lakhs of rupees. In case where the tax is up to 10 lakhs of rupees, you only have to pay applicable tax and the interest. Now in so far as specified tax is concerned, which is basically the dispute arising or the demands arising on account of retrospective amendment in law, this scheme provides for payment of taxes only. It does not provide for payment of interest and penalty, which basically gets the immunity that is waived under the scheme itself. Now the only requirement is that you have to make a declaration under the scheme, and in case of specified taxes, specified areas, you have to withdraw your pending appeals, writs, arbitration and all those pending proceedings before the before any forum. Just one comment which we have mentioned over here, rest is all the procedure which we have tabulated over here. One comment is that there is a specific requirement of withdrawal of the pending appeal and proceedings, and there is no specific provision for revival of that pending proceedings in case my declaration or my application is not accepted. So I think that requires a clarification. Any specific comment on this scheme which has been introduced, particularly for this retrospective amendment in law?
So it appears that maybe even the TDS provision, defaults of TDS provision are also covered, because this Vodafone etc. matters are mainly TDS matters. So 2011 defaults, they will also get covered if my appeal is pending on a 2011 matter and I come forward to pay the tax and the interest. Then
No, are you talking on the specified case or are you talking on the cases before CIT appeal?
both. I'm talking about both types of cases. My appeal is pending, that is one case, or the other is where the matter is already reached conclusion before the courts.
No, like they are saying the retrospective amendment.
Yes.
The Vodafone case is
Vodafone
or Jain.
but pertains to a TDS default, because Vodafone was a TDS default.
So Vodafone may be a TDS default, but they brought in a law. They amended the law in 2012. They had that specific clause 112 or 114. Validation that even if the demand is nullified by the court, it will still be activated and they will be required to pay the demand. So this is kind of a soft to Vodafone that you pay the tax and interest.
So no, my question is then, it means that even this 2011 demands are also
That
covered.
is only under the retrospective amendment.
No, it nowhere says this as such.
No, any amount out of a retrospective amendment and where you have invoked the investment.
No, even in case of first, when it says tax area, it says tax
No, it can be
interest.
any.
So therefore one can probably go for, supposedly today the TDS notices are being issued by various authorities for various TDS defaults, and they are seeking to initiate the prosecution proceeding. I can go under this scheme, I can make the payment of TDS along with interest, and also pay 25% of the normal penalty, which may be 271 capital C, and then maybe get immunity from prosecution. So this is what
It may not be necessary. You see, that prosecution is for delay in deposit of TDS.
Right.
So it may not have bearing with 271C, where the the sense is that you use monies belonging to government.
Hmm.
You have legitimately withheld those monies and used it as part of your business. I don't think you can possibly link it to saying that it may result in no prosecution.
Maybe.
Yeah.
So this is was in so far as the scheme of direct tax dispute resolution scheme was concerned. Then there are certain miscellaneous provisions. I will very quickly run through this miscellaneous provisions. There are few amendments in provisions relating to appellate tribunal. Which major amendment is that now the time limit for passing a rectification order by the tribunal has been is now six months from the end of the month in which order is passed, as against the existing limitation of 4 years. And now, what is the major amendment? They say that to minimize litigation, they propose to omit subsection 2A and subsection 3A of where the assessing officer also has a right to file an appeal against the DRP order. In fact, this may actually backfire in the sense that instead of minimizing the litigation, but it will the effect would be that the DRP may be more inclined to confirm the draft, the additions or adjustment which are proposed in the draft order, rather than leaving it to the assessing officer to file an appeal. Because
I would tend to agree. This should be a retrograde.
This is what was happening in the past also.
The DRP may try to protect the interest of revenue.
Absolutely, yeah.
And the another amendment is that the limit for passing of an order by a SMC bench has been increased from 15 lakhs to 50 lakhs of rupees. And now I think this last bullet may not be relevant because now there is no appeal. But insofar as pending appeals by the assessing officer against the DRP order is concerned, there were certain judgments which say that even the assessing officer is required to make payment of the appeal fees, and for non-payment of appeal fees the appeals were dismissed. Now it says that no appeal fee is required to be paid by them.
This is added
Retrospectively. Now there is an amendment with regard to the taxation of income by way of dividend to provide that in case where the recipient is an individual or HUF and he receives income more than 10 lakhs of rupees by way of dividend, then over and above the dividend distribution tax which is paid by the distributing company, the recipient would also be liable to pay tax at the rate of 10% on the amounts of dividend received, and no deduction would be admissible against that amount.
I think one question has been received whether it is the dividend in excess of 10 lakhs. I think the entire dividend will be taxed.
Yes,
The entire dividend will be taxed.
10 lakh is only the threshold to consider whether or not it is taxable.
And whether this is, an issue is whether this is the dividend in aggregate 10 lakhs or is it per company?
No, in aggregate.
Because it says our company, because
No, dividend distributed by domestic dividend.
Paid by
By a domestic company.
Yeah, by domestic.
So,
Aggregate.
yeah.
One issue, one observation or comment which we have mentioned is whether it is discriminating in the sense that when a corporate company receives the dividend from another corporate, there is no such taxation, whereas if this taxation applies only if the recipient is an individual or HUF. So, but I think the logic appears to be that ultimately it goes to some individual or an
beneficial
HUF.
holder will always
So,
be
to that extent it may not be discriminatory. And then the issue is whether it leads to triple taxation. First, profits in the hands of the distributing company. Second, the payment by way of DDT. Third, the payment by way of the taxable income in the hands of the recipient. So again, and in fact, 14 I think won't get affected because this being a individual. But in case of where the individual carrying on a business, in fact, the issue would also arise whether 14A is applicable or not, because
But they said that you will not get any benefit, any deduction, etc.
No, for the purpose of calculating the tax.
Since the dividend is taxable but at a reduced rate of 10%,
Right.
can you claim that this is not exempt dividend? I think you can.
Yes, we can, because it is no longer exempt now.
Right.
No, but it says no deduction is paid on
No,
the
sir, this is
not
only for
calculating
calculating the tax. That is only for calculating the 10% tax. When I pay the tax on income over 10 lakhs, which I received as dividend, I will not get any deduction. But while computing my other income from business, I would have claimed various expenditures. So what we are seeking to provide that AO cannot apply 14A with reference to my all other expenditures. Now there are certain amendment which is done in 56 to specifically provide that in case of amalgamation of demerger, where the individual or an HUF receives shares in lieu of the shares of an amalgamating company, that would not be taxable as deemed gift in the hands of the individual. Then there are specific amendment in section 115 BBE to provide that in case of deemed income under section 68, 69, 69A, the set-off of losses would not be available. Actually, there was an ongoing judicial controversy as to whether or not those losses are available. So, they basically, to resolve that, they have brought in this amendment. Carry forward of losses and set off of losses under 73A, the only amendment is that you have to file your return of income in time in order to claim the benefit of these losses under section 73A, which is in line with the other provisions also. The last amendment is the bank guarantee. Presently, there is no concept of bank guarantee being given to withdraw for making an application to the assessing officer to withdraw the provisional attachment. This provision is sought to be inserted in the Act itself. So with this, we come to the end of our presentations. So,
thank you, Rohit, and thank you, Neeraj. We have received several queries, but in the interest of time, what we'll do is that we'll answer those queries on email, because we have a presentation after this on the indirect tax also, and we are running behind schedule. May I now request Mr. Ajay Vohra to give us closing remarks.
Friends, the budget as always is fodder for the tax practitioners. I think it throws up more unresolved issues which are ultimately to be litigated in court. And as you've seen from the discussions that have emanated here, there are many open-ended issues, open-ended controversies which today defy solution or defy opinion. This will only settle as the matters progress and as the courts deal with these particular nuances of the tax law. There have been some very drastic changes in this budget in the sense of the equalization levy, which is probably for the first time, the country by country reporting for transfer pricing, the income declaration scheme, and also the settlement scheme on the lines of the Karvivad Samadan scheme which was there in the past. I think these are welcome measures to reduce litigation, to reduce tax areas, and we will see over time how it eventually pans out. But as I always hold that tinkering with the law is one aspect, but what is really needed at the moment is actually a change in the mindset of the tax administration to reduce the tax deficit, the trust deficit between the taxpayer and the tax administration, for which the finance minister seems to be working hard. And the CBDT is issuing circulars from time to time in order to bridge the gap on understanding of different provisions of the law, on accepting court decisions in order to minimize litigation. Before I end, I think one curious issue, a proposal in this budget that has been engaging my attention is this conversion of a charitable trust into a non-charitable entity. That you pay tax on the accreted income,
Yes.
and you can become a non-charitable entity. To me, it is again the very ethos and very principle of a charitable organization where actually the assets and income vest in the public at large.
Right.
So can you say that a group of trustees who are actually administering the trust for and on behalf of the public can actually opt to convert it into a non-charitable organization by paying the tax at 30%? You are divesting those assets which have assumed the character of, public property for private gain.
But usually what, sir, we have seen is that you get a 12A registration only in a situation where the trust contains a provision that in the event of dissolution, the assets would be given to a similar trust having
Not true. So here, assume you got it at that stage, and
Yes.
now you are seeking to convert yourself into a non-charitable organization, and there are some instances in the past, I am not taking names, but this seeks to legitimize the conversion of a charitable organization into a non-charitable organization. That does not seem to be the intent.
Right.
Today, charitable organizations have amassed huge corpuses.
Yes.
There may be private greed to convert such an organization that you set up 20 years ago to now become a non-charitable organization and get at the corpus of that charitable organization.
Right.
I only hope it doesn't,
Yes.
give an impetus to this kind of dishonest intent with regard to charitable organizations. So this to me was intriguing that the government has sought to, bring this to tax.
Sure.
So friends, I think the dust will take some time to settle down, and as Rupesh said, the queries that you raised, in the interest of time, we are not able to respond at the moment, but we will certainly get back to you on email.
Email, yes. We will respond to each and every query of yours. Thank you very much, and now our indirect tax team will take over. Thank you.
Thank you.
Good evening, friends. After a long session of direct tax, we'll now take you through the proposals which have been brought in the Union Budget 2016-17 under the indirect tax acts. We'll take you through first the service tax and then thereafter the customs and excise act. Now I can ask my colleague and friend Shilpa Sharma to take us through the various proposals which have been brought out in the budget speech stated by Mr. Arun Jaitley on 29th of February. May I request Shilpa, you can start, and I can always interfere in between.
Yeah, sure.
Thanks.
Thanks. Good evening, friends. Basically, these changes under indirect tax focus on rationalization to boost Make in India and reduce litigation. That is what I've understood from here. There have been a lot of changes in the sense, like actually not really changes, but they have simplified the language. So it's like old wine in new bottle. That is what I can talk about the indirect tax changes this year. So let me start with the service tax changes. Yeah, this applicability of provisions in Finance Act, there are various dates which are there. There are new provisions which have been there. There are amendments and omissions of provisions which are made, which have various dates of effect. Service tax rules will be effective from 1st of April 2016. Point of taxation will be with effect from 1/3/2016, and Senvat credit rules from 1/4/2016. This year, they have introduced something called a Krishi Kalyan cess. Like earlier, we had this Swachh Bharat cess, which was introduced by the Finance Bill and levied in the month of November last year, where in that case there was no credit which was available under Swachh Bharat cess. Now this KKC, I'll call it KKC instead of Krishi Kalyan cess. This KKC is to be levied on all or any taxable service at the rate of 0.5% of value of taxable services. The service provider is allowed to utilize the credit of KKC paid on input services for payment of such cess on output services provided, unlike in the case of Swachh Bharat cess, where no credit was available. No consequent amendment made under CCR, though this was actually spoken by during the speech that credit will be available. They have not come out with any kind of a notification as yet, so we do not know when the notification will come, but I think it should come probably in the month of May, because it's going to be applicable from 1st of June 2016. Also they have specified that date of invoice or date of payment, if it is prior to 1/6/2006, KK cess is not applicable. And in case the date of invoice or date of payment, which is 1/6/2016, only then KK cess will be applicable. Now what they have done is this POT rule 5, which is there, that will apply mutandis mutandis. That means that under this rule 5, they have said that there is a new service or a new levy by which such a cess can be levied. So Krishi Kalyan cess is basically mentioned in Rule 5 now to remove all the confusion that was raised during Swachh Bharat cess.
Yeah, but I think in relation to KKC, they are very clear that this will be senvatable, whereas a lot of ambiguity was created in relation to Swachh Bharat cess, where the amount paid or on account of Swachh Bharat cess is not creditable. Only you can claim by way of a refund in cases of exports. Yeah, so that's an underlining
Yes.
difference between KKC and Swachh Bharat cess. And in any case, if a person of a current company has to undertake big transaction, they might in between these 2 months, 3 months